Hello everyone, welcome and thank you for joining us today. So today we're going to talk about some estate and gift tax planning opportunities and changes, especially with all of the proposals that have been coming out this year, and also looking at some items you may want to take action upon or you may want to consider with these proposals that we have before us. So as Brian said, I am Eva Archibald. I'm a principal in charge of our Wealth Transition Services group. So I work with the group that we work with clients when they are looking to transition their wealth down to the next generation. Many times it's transitioning your closely held business down to the next generation. And we also work with the compliance areas of fiduciary, income tax, and GST taxes. So in our world, when we're looking at the proposed legislation, we have a number of them. Let's see, I think I went one too many slides, maybe. 3 proposals that I'm going to address today. That for the 99.5% Act, that was a proposal brought on by Bernie Sanders that addresses a lot of the estate gift tax exemption reductions. It looks at annual exclusion changes, so gift tax annual exclusions, addresses the GST rules, valuation rules, some rules regarding grantor trusts. Then we have the sensible taxation and equity promotion, known as the STEP Act. You may have heard that out in the media as well. That was announced on March 29th, so came out right after Bernie Sanders' proposal, but that addressed an elimination of the stepped-up tax basis on death, and also some basis adjustments on during life as well. If you aren't aware, we have estate and gift tax, but when that estate and gift tax is in play, the benefit of having an estate and gift tax is that anyone who dies with their assets, their heirs get a stepped up tax basis for income tax purposes to the value of those assets as of the date of death. So usually we've always had an estate and gift tax rate or tax assessed on assets either gifted during life or at death. But the flip side of that is we also had a stepped up tax basis for those assets held. Here now we have some proposals that are addressing both the exemption of the gift and estate tax as well as that stepped up tax basis. The STEP Act came in March 29th. That was set up by Senator Van Hollen. And then the American Families Plan came out on April 28th. That was proposed by or released by the Biden administration, along with the Green Book, which is the budget plan and a little detail to the American Families Plan of how they're going to generate this revenue under that American Families Plan. That came out on May 28th. So on May 28th, we received a little bit more detail of the American Families Plan, which really also addresses that stepped up tax basis on death or during life for gift transactions. It's interesting that the Biden administration, that American Families Plan that was set out or in the Green Book, there's no mention of the estate and gift tax exemption changes that was noted in Senator Bernie Sanders' plan. But I think we have to be aware of both. So the first one I'm going to address is the Bernie Sanders plan. But before we get to that, I think we have to look at where are we today. Today, we have a unified exemption for both transfers during life and at death. So for both gift and estate tax. We also have an exemption for generation skipping transfers. Those are transfers where a client may transfer not to the next generation in line, but skip. So instead of transferring your assets on death to your children, you may transfer them down to your grandchildren. There's an exemption for those transfers, and that usually is the same as your gift and estate tax exemption. Right now, gift, estate, and GST, the generation skipping tax exemption, for 2021 are all at 11.7 million per person. We have a progressive tax rate that tops out at 40%. So when you get to that 11.7 million, if I gave more than that during my lifetime, I'd have a tax during my life at 40% of anything I gave over that. Or if I died with assets over that 11.7, my heirs would be paying that 40% tax. We have portability of a deceased spouse's unused exemption in play, which means if I don't use all of my exemption during my lifetime, my personal representative could file an estate tax return and make an election to take my unused exemption and give it to my spouse. That's a great benefit that Congress, or excuse me, Treasury, has put out for us years ago. Probably the most advantageous thing that has come about with estate tax law changes is allowing that portability. It's nice to see that it does not appear that that is going away with these proposals. Portability will still be in play. We do have a sunset under the current law. That $11.7 million exemption is going to drop in 2026 to an amount of $5 million index for inflation since this law changed with the tax reform 2017. So 5 million as of 2026, we're thinking that's going to be about 6.5 million. So under the current law, you could have 11.7 million not pay any gift or estate tax. 2026, January 1, sunset provisions happen. That's going to drop somewhere around 6.5 million per person. We also have an annual exclusion, gift tax annual exclusion, available that anybody can give to any one individual, $15,000 per person. So a husband and wife can give $30,000 to one person each year, and that exclusion is totally on top of your estate tax exemption. So for the 99.5% Act, here's where things start to change under this proposal. The exemption for estate taxes will no longer be unified with the gift taxes. The estate tax exemption is looked at under this proposal to be 3.5 million index for inflation, with a progressive tax rate that tops out at 65% when applied after the first billion. Again, portability hasn't changed with this proposal, and the effective date for this would be December 31st, 2021. So at the end of the year. The new gift tax exemption is only $1 million. So here we have that difference. Estate tax exemption would be 3.5, but your gift tax, so if you gifted during life, you could only give $1 million. The progressive rate stays the same. It tops out at 65%, just over $1 billion. But the annual exclusion amount, where we had 15,000 per person under the current laws, here under the proposal, if you have a transfer to a trust or a pass-through or an item that's not able to be immediately liquidated, that exemption is only allowed for a double amount. So only 30,000, where under today's law, I have a client who gives 230,000 annually in annual exclusions to their children and grandchildren. If they were making that same gift through a trust under the proposal, they would be limited to only 30,000. The effective date for these transfers for the gifts is December 31st of 21 as well. So let's think about these annual exclusions, because this could be a significant change for some taxpayers if this would go through. So the limitation on the aggregate amount of annual exclusions available to each donor is going to be limited for transfers to trust, pass-through entities, which would be like a partnership or an S corp, transfers of an interest subject to a prohibition on sale, or transfer of property that, without regard to withdrawal, put, or other such rights in the donee, cannot be immediately liquidated by the donee. So maybe you have something like an option or a warrant that can't be exercised for a certain amount of time. That would be an example of a withdrawal right, or limitation on liquidation. The aggregate annual exclusion for those type of items shall not exceed twice the dollar amount in effect under the calendar year. So what that really means, unless the donor is giving property of cash outright, The donor is limited to $30,000 in annual exclusions. So for the client that I have that is gifting $230,000 a year, if they gave property into a trust that was over that $30,000 limit, anything over that would be using their gift tax exclusion. And if we're limited only $1 million under the proposal, that could make a big difference for some clients. Many clients use irrevocable life insurance trusts in their estate plan. An irrevocable life insurance trust is a trust that holds a life insurance on death, but it's owned by a trust, not by the individual. That way, the insurance proceeds are not subject to estate tax on their death. For those clients who gift their funds into a trust to pay those life insurance premiums through an irrevocable life insurance trust, they will find themselves limited to those two $15,000 annual exclusions. So for people who do estate planning through irrevocable life insurance trusts, the acronym you might hear there is at ILIT, they may need to watch themselves. It might be that they need to loan money into those ILITs or gift assets that produce income to cover some of those insurance premiums if that certain provision goes through. Now for the generation skip transfers, the GST transactions, those transactions are also noted in the proposal to change, where right now you can set up trusts that can provide for generation skip planning for many years. You know, we have dynasty trusts that can go on forever if we want to set a trust in place that continues to provide for our future generations. The IRS wants to limit that amount to 50 years. The lifetime exemption for GST planning will be at 3.5, which matches the estate tax exemption. Same progressive rate of 65% applied after that 1 billion. So it's a progressive rate up to 65%. Becomes effective as of December 31st of 21. And it's for trust created before December 31st, 2021. The exemption period expires 50 years after the enactment. So if I create a generation skipping trust after the law goes in effect, I have 50 years. If I have a trust today that's already in place, 50 years after the enactment, my generation skipping trust period will end. It will no longer be exempt from generation skipping tax. Grantor trust rules. A grantor trust is a trust I create. I might create a trust which keeps my assets out of my estate for estate tax purposes as a completed gift, but for income tax purposes might be still subject to me as a taxpayer. That's what's referred to as a grantor trust. Under the current law, a grantor can gift or sell assets to a trust, removing them from the estate, being a completed gift for estate tax purposes, but still be taxable income to me. No recognition of gain on a sale by a grantor trust. It's all as if I was that was the same taxpayer. It's disregarded for income tax purposes. The IRS wants to limit that. So assets of that trust are included in the grantor's estate for estate tax purposes. So assets less the taxable gifts would be included in the grantor's estate for estate tax purposes. Distributions to beneficiaries out of those types of trust would be deemed gifts to the grantor. So if I had a grantor trust set up and then I made distributions out to the beneficiaries under the new laws, that would be a gift to the beneficiaries. Where grantors cease to be treated as owner, that would be a deemed gift. So if I have a grantor trust and I turn off that grantor trust status, that would be taking it away as my owner, as the owner back to me. The effective date of these changes apply to trust created on or after the date of the enactment, to any portion of a trust established before the date of the act, which is attributable to the contribution made to such trust. So if I have a grantor trust in place and all's fine now, once I contribute new assets to that same trust, then I would fall under the new rules. So you'll want to be careful if you have that type of trust. If this law goes through, or this proposal goes through, you probably do not want to add assets to that trust. And to any portion of a trust established before the date of enactment, these grantor trust rules apply because of a transaction on or after that date of enactment. Again, making distributions, adding property, need to be careful in that regard. Here I'm bringing up an illustration of a technique we use, which is called a grantor retained annuity trust, sometimes referred to an acronym of a GRAT. This is an illustration because this is one area that is noted in the proposal. So under a grantor retained annuity trust, this type of transaction is right in the Internal Revenue Code section. They describe this type of technique where you can transfer assets valued today to a trust created, which would be out of your estate for estate tax purposes, but taxable to you for income tax purposes. So you can transfer assets over to it, and because it's disregarded for income tax purposes, doesn't trigger any capital gain, and I can take back the value of those assets in an annuity stream over a term of years set by myself as I create that trust. Might be 2 years, might be 10 years. As long as I don't die within the annuity period, those assets are out of my estate. So if I transferred $1 million into a grantor trust and took back an annuity stream for $1 million, and say it was stock, and that stock increased in value to $2 million over the next, say, 5 years, that added $1 million would be out of my estate for estate tax purposes, totally free from estate tax. It's a great way to transfer appreciated assets. However, the IRS under the proposal wants to limit that for a term not less than 10 years and not more than the life expectancy of the annuitant plus 10 years. So it's limiting the ability to use short-term grats. Sometimes we use short-term grats and we do multiple short-term grats that just keep rolling over. They are called rolling grats. That would no longer be allowed. Fixed amounts, the annuity payments, when determined on an annual basis, under the current laws, we can decrease that over time. That wouldn't be allowed under the new proposal. And the remainder interest, if I transferred over $1 million, today I could take back $1 million and really have no gift element to it. The IRS says you cannot take that remainder full $1 million. You'd have to take not less than an amount equal to the greater of 25% of the fair market value of the property in the trust, or 500,000. They don't want us to have what we call zeroed out gift. Transfer those assets over, take the full value back, not using any gift exemption. That would become effective as of the enactment date. So we'll see what happens there. It's interesting. It's in the code section right now, but they want to change and make some limitations there. Here's an issue that is getting quite a bit of discussion. In this proposal, they are looking to change the discounts available when we own fractional interests. So if I own a business interest, but I don't have the controlling interest, or I have a limited interest, I can take for gift and estate tax purposes a lack of control and a lack of marketability discount on the value. If I don't own 100% of the asset that's taxed for estate and gift tax purposes, you can compress the value for gift and estate tax purposes. The rules in the proposal want to change that and disallow the discounts for non-business assets. So for example, if I have a value of a non-business asset held in an entity, that will be determined as if the transfer had transferred the assets directly to the transferee. There will be no valuation discount allowed with respect to those non-business assets. So if you have cash, stock, bonds held in your partnership, not necessarily needed for a business or as a business asset, those would not be allowed to have a discount, where now you can have marketable securities in a partnership, and based on the terms of that partnership, you may be able to discount those marketable securities for lack of control or lack of marketability, depending upon your ownership in the partnership entity. That is going to no longer be available. They have a look-through rule. The assets of the entity owned by a subsidiary entity, of which the parent entity owns at least 10%, are treated directly owned by the parent entity. So you can't be stacking entities looking for additional discounts. That is going to be limited. This effective date shall apply to transfers after the date of the enactment. Now we look at the American Families Plan and the Green Book. So this again is the Biden administration of what they have addressed under their proposal. Theirs, interesting enough, does not have anything in regard to reductions in the estate, gift, or generation skipping tax. It addresses an elimination of the stepped up tax basis, or a tax on your capital gain for gift and transfers on death. So the donor or deceased owner of appreciated assets would realize a capital gain at the time of transfer. So for a donor, the amount of the gain realized would be the excess of the asset's fair market value in the date of the gift over the donor's basis in the assets. For a decedent, the amount of gain would be the excess of the asset's fair market value on the date of death over the decedent's basis. So very different than how we address this currently. So under the current law, if I received a gift, I would take the tax basis of the donor. So in my family, they own farmland that has been held in the family since the 30s, in the Depression days. So they bought this land at a very low cost. If my father would transfer that land to me under the current law, and I sold it, when I sold it, I would take his tax basis and pay capital gain. Here under this proposal, they're saying at the time he transferred it to me, I would have to pay that gain would be triggered, excuse me, that gain would be triggered at the time of that transfer. Under the current law, if my father died with that land, I would get a stepped up tax basis to the current value today, and there would be no gain for me to pay if I turned around and sold it the day after he passed. Here, if he transferred it to me in the new, under this proposal, there would be capital gain triggered at his death for his basis, between his basis and the fair market value. That gain would be on his final personal tax return. So the gain would be taxable income on a federal gift or estate tax return or on a separate capital gains return. That's how it's stated in the Green Book. But as we've read more into this, it appears that what they're going to do is have that tax calculated on the final 1040. And how that will play out is that gain would be reported on the final 1040, triggering tax. And then you would get to take that tax as a deduction on the estate return. Doesn't specifically state what happens on a gift tax return, but hopefully, if this does go through, they would match that on the gift side so that you would get an offsetting credit on the gift tax return as well. Not sure how that would play out for the gift tax, but on the estate tax side, the tax is on the final 1040. You would get to use capital loss and carry forwards from transfers at death. You'd be allowed that to be used against capital gain income up to the $3,000 of ordinary income. So right now, a taxpayer who has capital losses can at least carry $3,000 of that against ordinary income every year. You'd still get to have that under this type of transaction. And the tax imposed on the gains deemed realized at death would be deductible on that decedent's estate tax return. So think about this. Here in this case, we have income tax on the 1040. We have estate tax if they're over the estate tax threshold. Some people have interpreted this to say, well, either I'm paying one tax or the other. That's not quite how it works. You'd calculate capital gains tax on your final 1040. That tax is a deduction on your estate tax return, which right now is at a 40% tax rate. You'd get to take that as a deduction, but it isn't going to be either or. There is an exclusion of $1 million per person, $2 million per married couple. So as you look at your capital gain, I will get to exclude at least $1 million per person on death or during life. And that exclusion is in addition to transfers of tangible personal property, transfers to a spouse, transfers to charity, or if I transfer to a charitable trust, it's whatever portion is a charitable deduction in that transfer to a charitable trust. Capital gain on certain small business stock, and the exclusion for a gain on a personal residence. Currently at $250 per person, you would get to add that and have that as an additional exclusion. There's also exclusion for family-owned businesses and farms if the assets are given to an heir who continues to run the business or farm. This, I questioned in the American Families Plan. It didn't tell us like how long this exclusion would be for a family-owned business or farm. In the Green Book, it states that it's as long as that family member continues to run the business or the farm. That is, I'm glad there was that clarification. That's helpful. I'm still concerned though, what about the family-owned business and farm that doesn't have a family member to carry on? We all know there's many closely held businesses and family farms where the kids have dispersed, no one's taking over the farm. $1 million threshold per person is not very large. What happens to that? That's going to trigger a significant amount of gain for the family if someone isn't stepping up to continue that family farm or that business. There is in the Green Book a reference that if you're not electing this exclusion, you can pay over a 15-year period. It's not very clear. I'm hoping the intent there is that for these family-owned businesses and farms that don't have a family member carrying on, there will be a 15-year payment plan that they will be able to pay that tax. The gain on unrealized appreciation recognized by an owner of a property held in a trust, partnership, or other non-corporate entity is addressed. It stated that if property has not been the subject of a recognition event within the prior 90 years, with such testing period beginning on January 1, 1940, they will have a recognition event of any of the unrealized appreciation if the property is held in a trust, partnership, or non-corporate entity. So what that's saying is we could have a trust or a partnership that for many years, the gain just continues to roll within that entity. The IRS is limiting that, saying you can't let that roll longer than 90 years. If there is no gain on the unrealized appreciation with a beginning date starting in 1940, you're going to have to recognize that capital gain. So the first possible recognition event in that case would be December 31 of 2030. So if a trust is sitting in place and it's been going since 1940, by 2030, you are going to have a recognition event. Again, this appears that they're trying to limit the benefit of these dynasty or lifetime trusts for people. The per person exclusion is indexed for inflation after 2022. And it's made portable to the decedent surviving spouse. That, again, I think is a great benefit here. If this does come into play and they're allowing it to be portable to the surviving spouse, then that surviving spouse would then have $2 million available. The effective dates after December 31st, 2021 for gains on property transferred by gift or property transferred at death, and January 1st, 22 for certain property owned by trust, partnerships, and other non-corporate entities. That January 1, 2022 is trying to tie into that 90-year time frame. So we have that STEP Act that was still there. That was introduced by Senator Van Hollen and a number of other senators who joined in. It's referenced as the STEP Act. Again, came out before the Families Plan, but has a lot of very similar terms to it. The one thing that varies is under that STEP Act, it's saying that that stepped up tax basis would become effective for transfers occurring after December 31st, 2020, and in taxable years beginning after that date. So it's making it back to January 1 of this year, which does away with us having any time frame to do any planning. Where the American Families Plan in the Green Book is to December 31st of 2021, it gives us some time here from now to the end of the year to do some planning. The Van Hollen proposal under that STEP Act is looking to make that as of January 1. I find it hard to believe that when the Biden administration now is referring it to December 31st, that we would be looking to an earlier date, but I think it's interesting that that's a major change between the two of them. There are proposals that are addressed in the Green Book that say they will become effective as of the announcement date. That is true, but into this stepped up tax basis or this allocation of gain on gift or estate, it specifically references December 31st of 2021. So I'm just going to peek. I see I have a number of questions here. I have a question here that asks, with small apartments, will they qualify for the deferral under sold not upon inheritance at death? I think the question is here of will small apartments qualify as being family owned or operated businesses? It goes back to look at if you are an active trader business. So if you have your real estate and you're an active real estate holder, you would qualify under that. So let's move into what do we want to consider as we move forward. Well, one is planning with portability. So if I go back to Senator Bernie Sanders' proposal, and we're talking about changing the gift exemption or the estate tax exemption, I think we want to be sure that we have planning documents that allow for portability. Because right now under the current law, if I died today and I didn't use my 11.7 million, my husband could file an estate tax return or my personal representative and transfer my unused exemption to my husband. So today, if I die in 2021, I don't use my exemption, my husband will have my 11.7 million plus whatever the exemption is when he passes. So if he passes next year and the exemption is at 3.5, his exemption will be 3.5, but he'll still have my 11.7 million exemption to use. So if you think that your estate might be over the exemption of where it's being proposed to drop, you want to make sure and probably make that portability election on an estate tax return filed at death, because the portability amount is not adjusted for inflation, but it also doesn't go down. It stays at the amount as of when that first spouse's death occurs. So if the exemption is less than that, doesn't matter. You still get the higher exemption from your first deceased spouse. Gifts made after that time are used from your deceased spouse first and then your exemption. So if I thought that together we could have an exemption that would be less than needed it would be beneficial for me to transfer my assets to my spouse sometimes, let him get that second stepped up tax basis, because he might live for another 30 years longer than I. My kids would have a new stepped up tax basis if the whole basis adjustment proposal doesn't pass. But under the current plan, I think you want to be sure you're planning for portability, since we have a threat of a reduced estate tax exemption. And we know even under the current law, that exemption is going to happen in 2026. Clawback is a term we hear. I have many clients who ask, well, what if I use my larger exemption today? Well, the IRS be able to claw back or penalize me if the exemption drops at a later date? The answer under the current regulations is no. In November of 2019, there was a final regulation that was published that states that the estate tax exemption is computed, using the higher of the exemption applicable to gifts made during life or applicable at death. So if at life my exemption was 11.7 million and it was something less when I die, if I used it when it was 11.7 million, they're not going to be able to claw it back, take that higher exemption away from me. Here's another consideration that some people don't think about, is we have this higher exemption today at 11.7 million. We know it's going to drop in 2026 to maybe 6.5 million, and there's a proposal to drop it to 3.5 million. Well, what happens when it drops? Let's say it does drop to 3.5 million, and I've used already 6 million today. Well, when it drops to 3.5 million, I have nothing left, because you use it from the bottom up. So if I've already used up my 3.5 million, maybe with larger gifts of 6, because that was available to me, if it changes to 3.5 million, I don't get another 3.5 million. I've already used it. There's no exemption remaining for me in the future. So your exemption is used from the bottom up. The only way to use this higher level of 11.7 is to use everything from where we know it's going to go at 2026, then go up from there, and you can go up to 11.7. The gifting techniques we see with the threat of a change of an exemption is a spousal access trust, a sale to a grantor trust, a grantor retained annuity trust, which I've already briefly described, so I won't go over that one again. And the other thing we see is defined value clauses, language that allows us maybe to have an adjustment in value. So I'll use the spousal access trust first and explain this. If I want to use my $11.7 million exemption, that's a big number. Maybe I don't want to lose the cash flow with that. So I could transfer $11.7 million of my assets to a grantor trust and have my spouse be the income beneficiary. That way I would have a completed gift using my exemption. As long as the spouse is the income beneficiary and we're still married, I would still have the income available to me. The remainder on my spouse's death could go to children or whoever I choose to transfer to. The funding in this regard is something you can use from one spouse using all of their exemption, or you could have both spouses use their exemption. They could each use their 11.7 million, creating a trust for each spouse, where the spouse is a beneficiary, but you don't want them to be reciprocal trusts. They can't be identical trusts. They can't be created at the same time. It has to be a separate transaction. Many times I have a spouse who might want to use 11.7 for one spousal access trust, and maybe the other spouse keeps their exemption and lets it fall wherever it may. With portability, whatever exemption the second spouse has can be made portable to the other spouse if needed. But that way you're hedging your bets somewhat, especially if you're right at the threshold of about 22 million 23, 24 million where the exemption is today. Maybe just use one exemption now and let your other spouse keep their exemption. Here's a sale to a defective trust, similar to that grantor retained annuity trust, where I can transfer assets to a grantor trust. Where in the annuity trust, we took an annuity stream back. Here we can take a promissory note back. So we do a sale to a trust. It's a grantor trust, so it's disregarded for income tax purposes. There's no capital gain created on this transaction. I take a promissory note back for the value of the assets I'm selling. And then at a future date, I can let it transfer on to my beneficiaries. But while this note is in place, the distributions that come to the trust from holding the asset will be made payable to me on my note. If the exemption looks like it's going to drop, I could give the balance of the note. So again, when I'm looking at this and then a sale, if I sold $1 million of assets, took $1 million note back, I didn't use any exemption here. I took my $1 million note back. All the appreciation in that trust is out of my estate going forward. The assets I transfer in will be used to make payments on my note. And then if it looks like the exemption is going to drop to a significant number, I could easily give up my promissory note. You know, I referenced $1 million, it could be 10 million, and you could give up a $10 million note with your $11.7 million exemption. Here, you just have to make sure there's some equity in your trust at the time you do this transaction. But other than that, it's a great way to shift a significant amount of wealth when you know your asset is appreciating and you're setting yourself up to use the higher exemption on short notice. If you want to set the structure up and then decide later, the gift would be just the gift of the promissory note. Now for defined value clauses, when we have a big change in legislation, it seems to be that we run out of time sometimes to get the valuation, or maybe for our attorney to get documents drafted. Everybody's calendar gets very full. We saw this in 2012 when the exemption was dropping from 5 million to 1 million. Here this year, with this, all the changes that are going about, professionals are going to be busy, and it's going to get to a time closer to the year end when people can't maybe determine exactly what the value of the gift is or get the appraisal of the asset they're valuing. What they can do is say they're going to transfer an asset or say a number of shares at X amount. So instead of defining it as a specific number of shares, you're saying shares in a company valued at X, based upon as finally determined for estate and gift tax purposes. That way, you know you're giving a value of assets, and once you receive the appraisal or the IRS reviews the appraisal and decides what the value is, you can then determine how many shares you're transferring. It's a defined value clause, and very important that you base it as finally determined for federal gift and estate tax purposes, so that you can adjust if the valuation adjusts later, or if you don't have time to get the valuation before making the transfer. Now I'm going to take the last few minutes here to talk about how do we plan for this stepped up tax basis or capital gain transactions that may generate tax on gifts or transfers on death. Couple things I'll address is we may want to be harvesting our capital gains, maybe do some planning and structuring that, spreading out the gain. If we are charitably inclined, we could find a benefit in using charitable remainder trusts, or we could look at installment sales as maybe some planning before year end. So first I'll talk about the harvesting gains. So when I think about harvesting capital gains, maybe it's something we really want to look at. What capital gains do we expect to have? And should we be shifting the recognition of that capital gains from our higher future tax bracket to a lower tax bracket year. So if I know I have a substantial amount of capital gain in my assets, and if I die, all of that capital gain is going to be on my final personal income tax return, less my $1 million exemption, it could very well push me to a higher bracket, because in the proposals is a proposal that the capital gain rates, if your taxable income is over $1 million, could be pushed into ordinary income tax rates. Well, in these final 1040 years where we have a significant amount of capital gain to report, that's going to push us into a higher bracket than if we take that capital gain and maybe we spread it out for a number of years in our later years in life to take advantage of the lower gain rates instead of pushing it all in a year of death or in a year that we're going to make a gift. We can have the ability to spread out capital gain over a number of years, not taxed, again, all in that year of death or in a year of gift. Maybe we do some planning ahead of time for that. The things you want to think about is, the tax will be paid sooner than needed. So if I'm doing this over a number of years, I'm paying tax earlier than at death. What's the time value of money? How does that play out? But then you look at the flip side. The tax that I am paying now during life is not in my taxable estate if I'm subject to estate tax, because I've removed that cash from my estate. So it will probably take some calculations to see what is beneficial, but maybe worth looking into. Excuse me. Another thing to think about is spreading the gain. So I have appreciating assets, let's say, and maybe I want to consider gifting those appreciated assets now to allow for the future gain to be spread out over a number of family members or non-grantor trusts. So if I know I may have assets that are going to be sold to a third party or potential sale might be coming up, if the law passes and that threshold could bump me over to where we would be paying ordinary income tax rates on that capital gain in the future, maybe I want to gift that to my children now and spread out multiple brackets that might alleviate some of that ordinary income tax when it's sold. It would then be sold by my children with multiple different brackets, and they might be in a lower rate than I am. Or maybe I want to sell to my family members or my non-grantor trust to freeze the capital gain rate at this rate this year, so that when it's sold in the future, less would be subject to that ordinary income tax rate. If we have an idea that there's going to be a future sale, especially fairly soon, and you're concerned that that ordinary income tax rates might be passed for the capital gains, planning ahead of time may be beneficial. Another thing to think about is uncharitable remainder trusts. Those are trusts that we create, that we transfer assets into a trust, and an income interest is given to a donor or the donee. So I might reserve an income interest back to myself as donor for a number of years or my life, with the remainder going to charity. That portion that goes to charity is not subject to the capital gain on the transfer. It's called a split interest trust. And we can create it for, like I said, a term of years or the life expectancy of an individual. It allows us to spread the capital gain on any sale. So if I transfer the asset to a trust and that charitable trust sells the asset, all the gain isn't paid by the charity, it's set aside and it's used to make that income distribution back to myself for however I have set it up, the term of years or over my lifetime. The income earned in a charitable trust is earned in buckets, let's say. So we have ordinary income, we have the capital gains that they've earned on maybe what they've sold, tax exempt income, and non-taxable income. Well, if I've transferred assets to a charitable trust and say I'm going to take back a income interest of $40,000 a year, if that trust makes ordinary income of $40,000 a year, that will come out to me, and that will be ordinary income of $40,000. But if they have ordinary income that makes up the $40,000, the capital gain that they have generated from whatever they've sold over the time, that stays in that capital gain bucket and may never be taxed. So how that really plays out is I've set it out here. You have a contribution of assets made to a charitable remainder trust. The charitable remainder trust, because it's a charitable trust, does not recognize, it can sell assets without recognizing that gain in the year of sale. The gain is recognized as payments are made out of the buckets of income. But if they've sold the assets and invested assets and have vested the sale proceeds and have generated interest and dividends, that would be ordinary income that would come out to me. If that covers my annual payment coming back to me, then that gain just sits in the charity and is never taxed. It may be deferred until needed to use for my payments, or it may never be taxed. The lifetime charitable deduction is available for the charitable portion. So if I did this during life, we calculate what's the value of the income interest coming back to me based on the AFR rate and the term or my life expectancy. We calculate what that value is, and then we calculate what the remainder charitable value is. That charitable piece can be an income tax deduction for me during my life. At death, that charitable piece is an estate tax deduction on my estate tax return. For installment sales, if I have an asset that I may want to transfer to my children, and if this stepped up, or excuse me, I always say stepped up tax basis proposal, but it's really a capital gain proposal on a transfer, either during lifetime as a gift or at death. If that does go through, using installment sales could be a way to extend that gain over time. So if I sell an asset in exchange for a promissory note, that transaction can be structured so the capital gain is recognized by the seller, deferred until payments are received. You don't have to tax it all in this 1 year. It could be a sale from a taxpayer to, say, a non-grantor trust or a child. So if I do that sale to a child, now the child has purchased the property, his new tax basis is the purchase price. That way, when that child sells it down the road, his basis now is at purchase price. He might have, again, less to pay at that ordinary income tax rate. If you do this sort of structure, you want to be aware of a 2-year sale rule. If I do an installment sale to a related party, that related party can't turn around and sell it for 2 years, or you trigger all of the capital gain. You want to wait 2 years and a day, or 2 years and some time before the second transaction happens. You're giving yourself the ability to pay the tax over time, spreading the gain over time. You may avoid the higher tax brackets. You can elect out of accelerate. You can elect out to accelerate the income. So if I don't want to spread it out and I want it all taxed this year, I could do that. That election has to be made on a timely filed return. So a timely filed return would be my income tax return with an extension. And the extension date for a personal return is October 15th. So I could sell on an installment sales contract this year. And I have until October 15th of next year to decide what I want to do and how I want to tax that gain. So if these proposals go through, and as they're written under the American Families Plan, saying it would happen as of December 31st of 21, I could decide next year, how do I want to treat that income? And at death, the installment sales method carries over to the beneficiaries. So if I treated it like an installment sales contract and then I died, they would pick up, my beneficiaries would pick up that installment sale plan for the future. Where and when will these proposals happen? There's a lot of discussion happening. It may likely not happen till later this year, August, September, where we see something really happen, or maybe it might not be till next year. There's no guarantee that the proposals will happen, but the best way for us to plan is to plan for the law we know today, and then keep our proposals that are out there in mind and give us as much flexibility as we can. Many times it's going to be, we have to run the numbers to see what works the best and to give our clients the best options. So I do see I have just a couple minutes left and may have some questions here. Says, I believe I answered the first one. The second question I have is, for any of these proposed plans, will I still be able to gift $15,000 to each of my 2 kids and each of my 2 grandkids every year, exempt from my maximum total gift tax? Well, as I said, today you can gift that $15,000 per person, no restrictions. Under Bernie Sanders' plan, that proposal, he is limiting the $15,000 exclusion if you're transferring to a trust or to a partnership or something that's not easily liquidated. Then you are limited to just 2 $15,000 exclusions, so a limit of 13 or 30,000. So if you're gifting to a trust, let's say, you're limited to only 2 $15,000 exclusions. But if you're gifting strictly cash, you have the ability to give $15,000 to whomever you choose to on the cash transactions. Your restrictions are those transfers to trusts, partnerships, or to assets that are not easily liquidated. Another question, can I gift to a foreign entity or trust and have it no longer be in my estate? That's a loaded question. There are many restrictions on foreign gifting. Somewhat depends on what country you're working with and looking at. So that one might be better if you would email me, and I can work with my international team to answer that question. Here was a question: if the farm is transferred to a family member to continue running, but then the next generation sells it, is the basis the original owner's basis or stepped up at the time of death? The way I understand it is you can defer that capital gain recognition until there's no longer a family member operating the farm, but you don't get the step up on death as we now know it as of today. With that, we're right at the hour. If there are additional questions, feel free to email me, but thank you for joining us today.
Eva, there is one other question from Dean asking, will the tax you pay on capital gains at death be a credit or a deduction on the estate tax?
The tax paid on death that you pay on that final 1041 will be a deduction on the estate tax return, not a credit. So it's going to be a deduction. It would be a deduction which would reduce your 40% assets. Or excuse me, your assets subject to a 40% rate.
All right, and I think that was our last question. So thank you everyone for joining us today. Thanks to Eva for the presentation, and thanks to everyone for calling in, and have a great afternoon.